Hi, today we're going to talk about an important topic that often comes up in real estate transactions, capital gains. Understanding capital gains can help you make informed decisions when buying or selling property. So let's dive in. First, let's start with the basics. Capital gains refer to the profit you make when you sell an asset, like real estate, for more than you paid for it. Essentially, it's the difference between the purchase price and the selling price of your property. If you sell your home for more than you bought it, that profit is your capital gain. Capital gains can be classified into two types, short-term and long-term. Short-term capital gains occur when you sell a property you've owned for 1 year or less. These gains are usually taxed to your ordinary income tax rate, which can be quite high. Long-term capital gains, on the other hand, apply to properties held for more than 1 year. The tax rates for long-term capital gains are generally lower, which can result in significant tax savings. Now, how does this apply to real estate? When you sell a property, whether it's your primary residence, a rental property, or an investment property, you may be subject to capital gains tax on the profit you make. However, there are some important exemptions and strategies to be made aware of. For your primary residence, there's a special exemption. If you've lived in your home for at least 2 of the 5 years before selling, you may be eligible to exclude up to $250,000 of capital gains if you're single, or up to $500,000 if you're married and filing jointly. This can make a huge difference in your tax bill. For investment properties, things are a bit different. You won't get the same exemption as with a primary residence, but there are still strategies to help manage your tax liability. For example, you can use a 1031 exchange, which allows you to defer paying capital gains tax if you reinvest the proceeds from the sale into a similar property. Here are a few tips to keep in mind for minimizing your capital gains tax. Number 1, hold the property long term. By holding your property for more than a year, you can benefit from the lower long-term capital gains tax rates. Number 2, take advantage of the primary residence exemption. If you're planning to sell your home, ensure you've met the residency requirements to qualify for the exemption. And number 3, consider a 1031 exchange. If you're selling an investment property, look into using a 1031 exchange to defer your capital gains tax. Understanding capital gains and how they apply to real estate can help you make smarter financial decisions and potentially save a lot of money on taxes. If you have any questions or need personal advice regarding real estate, feel free to reach out to me. Also, a tax expert can help you with all of these questions. Thanks for watching, and don't forget to like, subscribe, and share this video with anyone who might find it helpful. See you next time.